Are you looking to buy or sell a business, but feeling overwhelmed by the financial complexities involved? Whether you're a seasoned entrepreneur or a first-time buyer, understanding how to evaluate a business's true value is essential. In this video, we're diving deep into the world of business valuations, uncovering the secrets to justifiable addbacks, and revealing pitfalls to avoid. That way, you don't overpay or overvalue a business if you're looking to buy one, or you don't overvalue a business if you're looking to sell one. So stay tuned, discover how mastering addbacks can empower you to make informed decisions and maximize your success in the business marketplace. Hi, I'm Trent Lee. I've sold over 600 businesses, and for the last 5 years in a row, I've been named the #1 business broker in the country for the most closed transactions per year. And I make these videos so that one day, when it's time to buy or sell a business, you'll know what to do, you'll be educated, and you'll know where to turn to get the best results. Today, we're diving into an important aspect of buying businesses or valuing businesses if you're a seller. That's understanding addbacks. I'm here to shed light on what addbacks are and why they matter in valuations for a business's financial health. Let me break down justifiable addbacks one by one. This is a general list of commonly accepted addbacks that are justifiable from a buyer's perspective, from a due diligence perspective, and from a lender's perspective. First up is depreciation. This represents the wear and tear on the assets over time. While it's a non-cash expense, it impacts the bottom line of the business. When assessing a business's true profitability, we add back depreciation to reflect a positive impact. Next is income tax. Businesses incur taxes, but they vary based on several factors. The seller's taxes may be different than your taxes. So we add back the income tax that you're essentially recalculating the business's earnings before taxes. This gives us a clearer picture of what the financial performance would be without the tax burden. Next up is amortization. It's similar to depreciation, but it applies to intangible assets like patents or trademarks. Like depreciation, it's a non-cash expense that affects the bottom line from a tax standpoint, but not truly a business expense. And so adding these back can impact the business's profitability. Next up is interest on loans or financing. Now, interest on loans or financing, some businesses have debt, some don't. Some have lines of credit, some don't. While it's a real cost, adding it back allows us to see the business's earning potential without the burden of debt service. The reason interest is added back is because business valuations are typically done on what's called a debt-free, cash-free basis. So if you're financing an acquisition, you'll need to factor in the interest that will be relevant to you, which may be higher or lower than the interest that the seller is paying for the business. So add it back, start with a net zero, and then factor in what applies to you specifically. Another commonly accepted addback is owner's health insurance. Small businesses sometimes cover the health insurance for the employees, the owners, and their family. By adding back the owner's health insurance, we're able to calculate the true earning available to the business. We would not add back the employee health insurance, just the owner and their family health insurance. The same goes for another commonly accepted addback, which is owner's retirement contributions. These are added back. These contributions are personal investments by the owner that don't impact the business's operations. Adding them back gives a better picture of what truly is going on for the business. The business owner may be adding more or less in their own retirement benefits than you plan to do so. Next up is an important one, a salary for non-working family members. So what about salary for non-working family members? Sometimes family members receive a salary without actively contributing to the business. In that instance, adding them back is okay. The key, however, is making sure that we don't add back family finances, or should I say family wages, if someone's actively, really, truly working in the business. Now that leads me to another important part. It's essential to note that we only add back one owner's salary. This ensures consistency and accuracy in evaluating the business's earning potential. After we add back one owner's salary, a good business broker would then factor in the fair market wages to replace the seller. This is important when calculating both SDE and EBITDA. The key here is adding back only one member's salary. If more than one member of the family is working, you can't add back all of the family's salary without replacing the fair market value of what they are doing. Obviously, if we're adding back one owner's wages, we can also factor in their payroll taxes. Now, here's where you have to be careful. Make sure to remove any one-time income, just like we would remove one-time expenses, PPP or EIDL. Sometimes some business owners have that listed as income. So while the government may have helped businesses with some one-time income, providing temporary relief, we need to remove that as income because it inaccurately overstates the business's true income and their profitability. While we're talking about one-time expenses, items such as lawsuits, legal fees, expansion, one-time equipment that's not repeated every couple of years, those can be added back as well. You just need to have good documentation that it's really a one-time expense, not a one-time expense that seems to happen every year or two. In that case, it's not an add back. Be sure to look for personal auto expenses. Sometimes a business owner may run their personal vehicle and the related expenses through the business. If it's really truly a personal expense, then it can be added back as long as you can justify the expense. Just make sure that you're not adding back something that really does require some type of a use of a vehicle. Now, here's a tricky one. Donations, like charitable donations, that type of stuff, those can be noble and helpful and great for the community if it's truly a personal expense. If the business owner is donating $1,000 to help their son in their Little League tournament, that's fine. But what I'm not going to add back is a business owner who's bought Golden Knight season tickets and he takes customers, some of his best customers and vendors, and he calls it personal expenses. Those are tied to the business and it's likely not an add back. So be careful if a broker or a seller is trying to push those add backs because they truly are a business expense if they're used for business networking and entertainment. And there you have it. Understanding add backs is fundamental when assessing the business's true value and potential. By considering these justifiable add backs, businesses, buyers can make an informed decision and sellers can present their businesses accurately. There's one more I forgot to tell you about. Let's talk about unreported cash. This is an important one because often I'll walk into a business that has unreported cash. But unlike justifiable addbacks, unreported cash should not be added back to the financial statements. And by unreported cash, I'm talking about the business income, the true income that didn't ever hit the business owner's tax returns or the business's tax returns. While it may boost cash flow and it may really truly be there, it's crucial to remember that if the seller hasn't reported it to the tax authorities, it can't be included in the valuation process. It's essential for business buyers and sellers to operate with transparency and integrity throughout the transaction. So if you come across a business that claims they have a second set of books with all their cash that's accounted for and they can prove it to you, tell the owner that they got the benefit when they stole it from the IRS. They can't double dip and get the benefit when they try and value the business. Either it needs to get on the tax returns and get counted for a valuation, or they need to walk away with the benefit that they got it by not paying taxes on it. Aside from whether it's even legal or not, that's not the purpose of this video. Just make sure you don't add back unreported cash. So before we wrap up, let's discuss a critical point: the dangers of overly aggressive addbacks. While addbacks can enhance our understanding of the business's financials, it's essential to exercise caution and avoid adding back items that shouldn't be included. Be careful if you're working with a business broker or a seller that is trying to add back too many expenses, and everything has a story. They're always giving you another story on why this and that should be an add back, but they can't completely prove it. Be careful, because you don't truly know what's going on. And as a buyer, you have to make justifiable add backs, not only for you and your own due diligence, but for the bank as well. So while we're talking about overly aggressive add back for things that shouldn't be added back, let me just touch on a couple, 3 or 4 items here. As we talked about, first and foremost is unreported cash. Don't even mess with it. If they can't prove it on the tax returns, then it doesn't count as an add back. As a recap on one of those things that should not be added back, adding back family members that are putting in time and effort into the business. It's one thing if their college son who's on payroll that lives out of state and truly does nothing and it's simply for a tax standpoint, that can be added back. But anyone else that's a family member that's working in the business, whether they say it's part-time or not, only add back one owner's wage and then factor in what it would cost to replace that owner at a fair market wage. Also be careful about disguised personal expenses that the business owner stuffs into the cost of goods category. While some expenses may be legitimate and personal expenses, but if they stuffed it into the cost of goods category line item, it can become really messy to verify and justify that. And lastly, be careful about a bunch of small expenses. Bankers, your due diligence CPA, they're not going to want to go through 300 receipts at Amazon or a local gas station that are all claimed to be personal. Really, the seller should have clean enough books to not have to go through that many little detailed transactions as add backs. If they're doing that, they're pushing it probably too much, and those should not be accepted as add backs. And that's why it's so important to work with a reputable business broker who understands the delicate balance between enhancing financial clarity and maintaining accuracy and transparency. Overly aggressive add backs can jeopardize the credibility of the valuation and undermine the trust in the transaction for both the buyer and their entire team, as well as the lender. Remember, the goal is to provide a fair and accurate representation of the business's financial health to facilitate a smooth and successful transaction for both parties involved. So if you're looking at either buying or selling a business and you need help and you found this video helpful, feel free to reach out to me. I can help you on the buy side or the sell side anywhere across the country, and I look forward to working with you. Thanks. Take care.